The global financial landscape constantly shifts under heavy economic weight. Observers currently note a fascinating dynamic unfolding across trading floors. Investors carefully watch precious metal valuations maintain their surprising stability. This delicate balance reflects broader anxieties within our modern economy. As a seasoned financial analyst, I recognize these underlying patterns. We must deeply analyze how shifting employment metrics reshape strategies. Recent data reveals a notable decline in initial unemployment applications. First-time claims fell by 11,000 recently. The newly released figures showed 207,000. This specific number came in significantly below previous expectations. Despite this sudden drop, the broader domestic labor market struggles. The total number of continuing jobless claims actually increased noticeably. They reached 1,818,000. It represents a significant rise from officially revised levels. These continuing claims represent individuals receiving national unemployment benefits. This divergence between initial applications and continuing claims highlights weaknesses. Companies remain highly reluctant to release their existing staff members. Extensive costs associated with future recruitment efforts deter these terminations. This unique situation creates a very specific low-fire equilibrium. Workers who lose their jobs find securing new employment difficult. Therefore, the overall labor market appears reasonably solid for many. This applies to individuals possessing steady full-time positions. Federal Reserve officials consistently monitor these specific employment indicators. The National Central Banking Institution continues navigating through tremendous uncertainty. They strive to carefully achieve maximum employment and stable prices. Current stagnation prevents financial markets from predicting aggressive rate increases. Consumer inflation runs above desired targets from tariffs. Energy shocks also complicate paths toward price stability currently. The producer price index jumped but remained relatively shy. Gasoline prices experienced substantial increases, directly elevating consumer readings. Federal Reserve officials publicly acknowledged these severe energy disruptions. Consequently, central policymakers hesitate to lower borrowing costs currently. Energy markets remain extremely volatile globally across numerous national borders. This highly unusual combination creates a perfect macroeconomic storm currently. Such an environment remains historically favorable for precious metals investments. Normally, a sharp decline in initial jobless claims strengthens currencies. Stronger national currencies typically weaken alternative investment assets like gold. However, these stubborn structural economic weaknesses provide steady underlying support. Gold firmly consolidated its current position above critical pricing barriers. It remains resilient above $4,800. This former pricing ceiling effectively transformed into robust foundations. Professional technical analysts confirm the upward pricing structure remains. It currently remains intact on long-term trading charts. The international spot price accurately reflects highly complex environments. Geopolitical risk premiums are heavily integrated into daily valuations. Market investors observe methodical upward grinds rather than surges. Buying interest continues emerging steadily at progressively higher levels. This steady accumulation occurs throughout ongoing daily financial market sessions. The broader international situation provides extensive support for refuges. Physical gold bullion serves as primary reliable defensive assets. Important diplomatic progress recently surfaced regarding potential temporary ceasefires. This sudden geopolitical development temporarily reduced immediate global fears. It mitigated concerns regarding widespread regional war and destruction. Despite these promising diplomatic discussions, critical shipping routes remain. A coordinated double blockade strategy effectively strangled energy portions. It heavily restricted global crude oil and natural gas. Commercial vessel transits plummeted drastically from standard historical averages. They dropped significantly through this incredibly narrow vital waterway. Such massive maritime disruptions previously led to cumulative shortfalls. These involved hundreds of millions of crude oil barrels. This drastic reduction in basic energy supplies drove prices. Fuel prices surged significantly higher across major global markets. Higher energy costs inherently act as powerful inflationary drivers. These drivers subsequently benefit precious metal valuations over time. The tactical nature of these maritime blockades continues shifting. Massive tanker ships repeatedly attempt alternative routes avoiding detection. Some vessels navigate circuitous ocean paths with transponders disabled. Authorities maintain strong interdiction efforts to control commercial traffic. Hopes for meaningful international diplomatic breakthroughs currently alter behavior. They allow risk appetite to return into equity markets. United States currency faced severe persistent downward pressure today. A significantly weaker national currency naturally makes gold cheaper. It becomes less expensive for buyers holding foreign currencies. Massive institutional capital successfully returned to the metals sector. Heavy consecutive outflows occurred earlier during this calendar year. Global exchange-traded funds backed by physical gold recovered. They experienced positive accumulation signaling, renewed professional investor confidence. Smart money participants view current price consolidations as phases. They recognize these trends rather than definitive market peaks. Central banks worldwide remain incredibly consistent buyers of gold. This occurs despite rapidly fluctuating short-term economic drivers. This continuous sovereign wealth accumulation creates remarkably firm floors. It heavily supports pricing across major international commodity exchanges. Neutral national economies increasingly seek safe refuge in assets. They avoid potential financial sanctions or monetary transaction restrictions. The domestic manufacturing sector provided surprisingly optimistic economic narratives. Regional indices measuring core industrial business activity outperformed estimates. They indicate a slow but remarkably steady industrial recovery. Increased domestic military production and completely reorganized chains help. They likely support this nascent industrial sector strength observed. A robust manufacturing sector rebound normally suggests economic resilience. This consequently supports a significantly stronger dominant national currency. However, institutional investors largely overlooked these positive industrial improvements. They prioritize mounting concerns regarding continually rising jobless claims. Blockaded maritime energy shipments further accelerate broad inflation fears. This makes gold an incredibly attractive hedge despite gains. Gold effectively competes directly against high-yielding debt instruments. This occurs constantly within our complex macroeconomic environment today. The entirely yieldless nature of precious metals becomes attractive. Systemic global counterparty risks increase significantly, driving this appeal. Major national economies currently hold truly historic debt levels. This fundamentally threatens the long-term stability of bonds. In bustling Asian markets, physical consumer demand remains prominent. It heavily influences overall global commodity price dynamics constantly. Domestic physical gold rates in India experienced sharp recoveries. They recovered following minor temporary dips earlier this month. This localized pricing directly reflects the immediate currency impact. A slightly weaker rupee against dominant foreign currencies drives. Retail investors across major Indian cities carefully track trends. Premium 24-karat gold recently reached elevated valuations. These specific local valuations include standard national import duties. They often completely exclude variable retail making charges entirely. Similarly, the bustling Middle Eastern physical markets serve investors. They act as absolutely critical avenues for capital preservation. Gold retail rates across Dubai and Abu Dhabi maintain. They sustain highly elevated pricing levels from persistent demand. These regional price disparities frequently reflect shifting liquidity constraints. They also highlight incredibly complex logistical international shipping costs. Meanwhile, vibrant Vietnamese markets presented highly unique local volatility. They contrasted slightly with dominant global pricing trajectories observed. Saigon Jewelry Company premium gold bars experienced unexpected decreases. These drops occurred during their recent afternoon trading sessions. Swift local liquidations happened as domestic retail investors reacted. They reacted to minor temporary pullbacks from international peaks. The standard domestic premium on physical Vietnamese gold remains. It stays significantly above directly converted world market equivalents. This massive price difference persists constantly despite market fluctuations. Financial experts strongly advise citizens against rushing unverified transactions. Returning focus to crucial American economic indicators reveals concerns. The current labor market dichotomy remains central analytical focuses. Falling initial jobless claims traditionally lead to higher rates. They create widespread institutional expectations of tighter monetary policies. However, continually rising continuing claims strongly suggest different realities. The broader domestic economy might be rapidly approaching stalls. A completely stagnant domestic employment environment severely limits policymakers. It restricts their fundamental ability to implement hawkish strategies. Persistent consumer inflation continues running well above economic targets. This occurs due to sustained international tariffs and shocks. This highly unusual combination creates a perfect macroeconomic storm. It inherently favors non-yielding precious metal investments consistently. Federal Reserve representatives frequently compare their incredibly difficult task. They compare it carefully navigating immensely powerful competing forces. They correctly identify dangerous inflation crosscurrents and mixed signals. These represent primary foundational drivers of our economic uncertainty. Maintaining a strict higher for longer interest rate seems. It seems paradoxically supportive of incredibly strong gold valuations. Because aggressive additional rate hikes currently seem highly unlikely. The immediate downside pricing risk for physical bullion limits. Financial markets continually price in future interest rate cuts. They predict government officials must eventually prioritize employment weakness. This broadly anticipated shift away from strict fighting protocols. It naturally provides immense bullish sentiment for precious metals. The highly volatile ongoing political landscape further complicates outlooks. It obscures vital international trade and global commerce predictions. National legislators recently debated intense resolutions designed to limit. They wanted to strictly restrict executive power over operations. Such intense ongoing domestic political friction perfectly reinforces appeals. It highlights the deep appeal of gold as hedges. National transitions toward a robust semi-war economy require. They demand truly massive financial layouts and deplete stockpiles. Consequently, federal government deficits widen considerably, raising serious questions. These concern long-term questions about sovereign debt sustainability. Global investors therefore naturally gravitate toward tangible physical assets. These assets exist entirely outside the traditional banking system. Physical silver also demonstrated highly impressive market resilience climbing. It climbed steadily toward newly established one-month highs. Essential industrial metals gather tremendous underlying support from refuges. They benefit from incredibly consistent demand despite market volatility. Financial analysts carefully monitor global silver markets for guidance. Silver very often acts as a highly volatile sibling. Major international mining corporations benefit significantly when silver surges. It reclaims previously lost ground following sudden geopolitical collapses. Increased production capacity perfectly aligns with current commodity markets. These markets are grappling with severe structural deficits currently. Precious metal streaming and royalty companies currently emerge successfully. They succeed within this high-inflation macroeconomic environment effortlessly. These highly specialized corporate entities easily secure lucrative surges. They avoid direct financial exposure to rapidly escalating costs. Traditional energy-weighted investment portfolios conversely experience cooling trends. This occurs as geopolitical war premiums strip out entirely. The overall global economic outlook remains tethered to ceasefires. We watch whether temporary agreements actually hold securely beyond. Genuine peaceful negotiations could completely stabilize gold valuations currently. This creates a highly predictable pricing range for planning. Conversely, tactical military resets might quickly trigger market volatility. This requires cautious investors to prepare strong defensive strategies. Astute strategic investors must continually identify excellent resource companies. They seek corporations possessing vastly superior all-in costs. Highly elevated precious metal prices make high cost profitable. This profitability spikes during intense short-term inflationary bursts. However, true lasting corporate success ultimately belongs to operators. They must overcome severe logistical challenges across fragmented landscapes. The recent price surge clearly proves significant market strength. It conclusively proves global markets are fundamentally shifting gears. Interconnected global financial systems progressively de-dollarize to shield themselves. They avoid dangerously weaponized finance and unpredictable trade embargoes. This steady systemic macroeconomic evolution provides constant term support. It creates foundational pricing support for precious metals globally. Crucial domestic employment data continues revealing stark economic differences. These exist across various distinct educational and demographic groups. Professional workers possessing advanced college degrees experienced large increases. Their specific unemployment rates grew when compared to averages. Jobless rates for Black workers remain significantly higher currently. They are higher than those recorded for white workers. The average overall duration of individual unemployment spells increased. It indicates severe difficulties in successfully securing job placements. Critical long-term unemployment metrics climbed sharply, forcing exits. Many deeply discouraged individuals eventually exit the workforce entirely. This massive growing inequality between steadily employed and unemployed. It presents significant challenges for future domestic economic stability. Professional economic analysts observe modest hourly wage increases occurring. They combined with falling weekly working hours yielding flat. Sweeping aggressive tariff policies failed to meaningfully boost employment. This happened despite original administrative promises and economic projections. Instead, these restrictive international trade measures contributed to inequality. They caused rising inequality and sluggish overall job growth. The intersection of brilliant technical market breakouts and shifts. It creates a highly compelling modern macroeconomic narrative analyzed. International spot gold prices successfully breached several-month barriers. They effectively established a remarkably strong new pricing floor. Institutional market participants fully integrated these existing risk premiums. They built them directly into their baseline valuation models. This highly decisive technical market breach signaled fundamental shifts. It highlighted a paradigm shift in broader institutional sentiment. Upward pricing structures remain perfectly intact while oscillating safely. They move within an expanding range, forming successive lows. The 50-day simple moving average recently emerged critical. It forms a dynamic support level preventing catastrophic collapses. Relative strength indicators occasionally display moderately overbought technical signals. They somehow avoid triggering any massive institutional panic liquidations. Instead, international financial markets routinely witness calculated professional reentries. These players were previously caught in unexpected liquidity squeezes. Gold successfully returns to its traditional role, competing effectively. It competes against high-yielding treasury debt instruments globally. When carefully comparing physical gold and exchange-traded funds, individual retail investors must rigorously consider various hidden costs. Purchasing heavy physical jewelry predictably involves paying government taxes. It includes extremely high variable retail shop-making charges. Exchange-traded funds completely eliminate these upfront retail premiums. They actively offer significantly higher daily open market liquidity. Holding heavy physical bullion fundamentally requires securing deposit lockers. It demands purchasing incredibly comprehensive domestic insurance coverage policies. Conversely, completely paperless gold investment instruments charge transparent ratios. These annual expense ratios typically remain below 1%. Both disparate investment vehicles eventually incur absolutely identical taxation. They face equal long-term capital gains upon sale. As an experienced professional financial analyst, I strongly recommend. Everyday retail investors must meticulously track international pricing trends. They should do this before purchasing anything locally now. Buying physical tangible assets entirely blindly during price spikes. This very often leads directly to immediate capital destruction. Truly understanding the complex underlying differences between prices matters. Analyzing actual local retail costs remains absolutely crucial today. Prudent individuals should systematically allocate investment funds utilizing products. Digital gold products specifically help avoid exorbitant manufacturing fees. Maintaining a widely diversified personal financial portfolio provides protection. It offers monetary protection against unforeseen rapid currency devaluations. It guards against sudden, unexpected domestic consumer inflation surges. Gradual methodical pricing accumulation strategies constantly perform significantly better. This beats desperately attempting to perfectly time commodity markets. The overall domestic labor market data clearly exhibits volatility. It essentially masks much deeper systemic national employment issues. Unadjusted weekly initial claims actually increased significantly, showing discrepancies. They differ from the thoroughly smoothed-out adjusted data. This extreme reporting complexity requires professional analysts to evaluate. We must review multiple distinct data points to assess. Weekly initial unemployment claims essentially serve as leading indicators. They highlight completely emerging domestic labor market conditions today. However, these specific weekly administrative numbers remain notoriously difficult. They resist being seasonally adjusted with absolute mathematical precision. Consequently, professional financial experts regularly place significantly greater emphasis. They look closely at the much smoother week average. This helps to accurately spot genuine macroeconomic trends developing. Reported continued weeks claimed provide highly reliable statistical evidence. They demonstrate the actual current directional trajectory of economies. They specifically represent struggling individuals experiencing tremendously prolonged joblessness. These citizens navigate an increasingly difficult and stagnant landscape. The highly concerning recent uptick in this metric warrants. It demands absolutely intense continuous monitoring by regulatory authorities. Complex seasonal adjustments basically attempt to gently temper fluctuations. These are directly caused by major annual holidays today. These highly advanced complex statistical models purposefully make trends. They make them much easier to accurately spot today. Yet even with highly advanced sophisticated numerical adjustments applied, the domestic labor market still clearly indicates a slowdown. It highlights a structural underlying economic weakness persisting today. In final conclusion, the entire global financial architecture stands. It remains at a highly pivotal defining crossroads navigating. We are traversing truly immense macroeconomic pressures from angles. Gold holding completely firmly at exactly 4,000 today. It consistently demonstrates incredibly deep ongoing systemic market concerns. Smart professional investors must continuously balance domestic employment softness. They weigh this against incredibly intense international geopolitical volatility. This comprehensive strategy guarantees successful portfolio management over duration. Understanding these complex interconnecting factors empowers individuals to choose. We must remain vigilant and continuously adapt our positions. This proactive approach secures wealth despite unprecedented market turbulence. Prudent decisions today build incredibly strong foundations for tomorrow. Success requires relentless discipline while navigating these turbulent economic times. Knowledge remains our absolute best defense against sudden financial ruin.